Hey, this is Attorney Andre. I have so many clients asking me about what's going to happen if there's a run on the bank. I mean, I literally answered this question 5 times today. That's a lot. Now, what do you mean by a run on the bank? A run on the bank typically means that everyone runs to the bank because the economy is so messed up. They run to the bank because they want to get their money out. But banks have fractional reserve banking. So essentially, if you give them $100 on your account, it's going to say $100, and you can, in theory, take $100 out. But the bank isn't going to keep $100 in its safe. A bank is going to deploy that $100 to try to make more money and keep a little bit, like let's say $10 in reserve. And that's okay if the vast majority of the money that you take from people you deploy and no one really wants that money back because they're happy with it being in the bank. But if everyone, just imagine if everyone runs to the bank and tries to get their money back, well, then it's going to be a huge problem because the bank just doesn't have enough. So they would have to either liquidate assets, sometimes at a loss, in order to pay everyone back, or not be able to cover. And that's what you had a lot of times in Silicon Bank when people came and they wanted to get their money out and the bank just couldn't pay them. Now, a lot of people are asking me, can that happen? And if you want an example of that happening in a different country on a large scale, think Greece in 2014. This happened in Greece in 2014, where the inflation was just skyrocketing. They couldn't do anything, and people were like, I need to get my money out because I can't keep my money in this bank. So there was a total run on the bank. The bank essentially had to close. There were lines for miles lining up at ATM machines. These ATM machines didn't really give much. And this situation never really happened in the United States. What we did have in the United States is we had a situation where the stock market crashed because you had a really terrible economic policy, and that you saw that really in the stock market. So you had that in 1928, the first time that anyone can really remember. 1928 was the Great Depression, and you had an 84% decline in the stock market. People lost their jobs. I mean, it was a terrible time to be around, and people lived through it. And we got to 1945. What happened in 1945? That's right, World War II finished. And you had in 1945 a 22% decline in the stock market. In 1974, thanks to the policies of Jimmy Carter, you had a 42% decline in the stock market. And then if you go to the year 2001, you had a 45% decline in the stock market. And then between 2020, you had the COVID, so you had a 30% decline. 2022, a 26% decline, and then you can't forget the dot-com bubble with a 50% decline in around 2008, 2009. So those are the major declines, the major economic pushes in the stock market that we all felt, that we all lived through. So what can you expect in the future? Because if you turn on the news right now, you're going to have half of the people saying that, oh my God, the stock market is going up. We're at all-time highs. Things are just going to get better and better and better and better. And then you're going to have the other half of the people that are going to say, it's a bubble. It's going to pop. It's crazy what's going on here. And then everyone is going to be broke. Everyone is going to be poor. And by the way, that's when you should buy, not now. Now is the place where you should stay out of the market. What is the right answer? And the reality is you don't know what the right answer is. And if you expect me to tell you, a lawyer, to tell you what the right answer is, that's really scary because I don't know the right answer. If someone knew the right answer, they'd be super wealthy. And there are people that might know the right answer. But here's what I can tell you from research. This is the God's honest truth. What you can expect from research is that if you look back at what the market is trying to tell us, you have a major trigger in the market, and that trigger happens to be the Fed. And the Fed has a 2% target for inflation. That's what they're trying to do. They're trying to get the inflation to wholly 2%. And how is that really turning out? Because on some instances, they're saying, look, we're making big progress. But where this inflation actually matters, and if you take a look at where it actually matters, your rent is up. Groceries are up. 2 handfuls of blueberries are costing you $8. A dozen eggs are costing you like $9. That's roughly $1 per egg. And then you throw taxes on top of it. So your rent's going up, your food costs are going up, your daily cost of living is going up, your gas prices are going up, electric cars aren't going to solve the problem. All of these things are happening in real time. All of these things are happening, and you have a situation where even if the Fed is saying that inflation is going down, you don't feel it. So what's there to do? If you look at the inflation numbers, you have a CPI average of 0.4 during the first 3 months. And what does that actually mean? That means that you have a 3-month annualized inflation rate of 4.5%. And that is expected to stay higher because everything that the Fed has done to throw a wrench into that has failed. They tried to get us to a soft landing, but that's failed. And even if you think the economy is in the right trajectory, the right path, you're still spending way too much on rent and you're still spending way too much on groceries. These core elements has hit inflation very hard, or has been hit by inflation very hard. And that's where you have this 4.5% potential indicator. So essentially, you have a boost in the stock market fueled by a lot of speculation, and it has to be fueled by a lot of speculation. If you think about it, it can't be fueled by anything but speculation, because if you look at a 33% increase or 30% increase year to date on the stock market, and then you take a look at what companies are doing, you have the average company that's profiting on average, or demonstrating on average a 4% increase in profit. So if you have a 30% stock market boost, but the companies that are generally around the stock market, or they're generally in the stock market, have an average increase of 4%, that means that stock price is not being based on fundamentals. That stock price is not being based on what the performance of the company. It's really being based on speculation about AI and speculation about other aspects, maybe real estate, maybe you have some REITs, but it's really a handful of companies that are boosting up, and most of those companies are tech companies that have to do with AI. So where is the quote-unquote smart money? Certainly you shouldn't listen to me. But if you were to listen to me, one of the things that I would tell you to do is look at where people are holding their money. And if you look at Warren Buffett, for example, Warren Buffett has $185 billion in cash just sitting around. $185 billion in cash, almost $200 billion in cash for an investment firm. What's the reason for that cash there? Because cash just sitting there, sure, it's an asset, and if inflation goes up, or if the Fed increases the interest rate, the cash has value. But a lot of the times people say cash is not great. We've got to spend the cash and bring more investments in. Well, you've got $200 billion in cash just sitting there in Warren Buffett's bank account. Well, probably in Berkshire Hathaway's bank account. What is that person waiting for? I think that there might be a golden opportunity. And that golden opportunity is when the Fed actually decreases interest rates. Because studies show that when you decrease interest rates, the net effect on the stock market is that the stock market decreases. So you have, at first, the stock market will go up on good news that the interest rates, money is cheap again. But then, typically, stock markets underperform. And they usually underperform by at least 10%. That's what the research tells us. So I think what's happening is that the people who are bears in this market are waiting for the Fed to say, you know what, enough is enough. We've reached the tipping point. Everyone is unhappy. We're going to decrease interest rates. We're going to start this easing process. And then once they do that, and they decrease interest rates and decrease interest rates and decrease interest rates again, the stock market will go down, and it'll underperform 10% year over year. And a lot of financial experts, and I'm thinking of Nick Maggiulli, and he's the chief operating officer of Ritz-Holtz Wealth Management LLC, and he's graphed the performance of the S&P 500 for 1 year after each of the 25 Fed rate cuts from 1994 to 2020, and found that returns were down, like I was saying, 10% year over year when the Fed starts cutting rates. So you have a situation where the Fed is going to cut rates, and then you have other experts who are saying that the market is a totally artificial bubble. And I'm looking at Harry Dent, for example. Harry Dent is someone that says that we're currently in a bubble, and it's been building up for the past 14 years, and then you have unexpected or unprecedented stimulus pumping, and that's what's keeping it up. And then once that ends, everything's going to go crashing down. And then essentially the bear analysis is that for the next 10-year period, you'll have a negative 5% return on your investments if you were to put it in the S&P 500. Now, historically, the S&P 500 has increased at an average of between 7 to 10%. Interest rates at banks are paying out 5%. And if someone is saying, wow, you're going to lose between 5 to 7% on a year-to-year basis for the next 10 years, or you can put it in essentially a money market account where you're gaining that 5% interest, that's something that's interesting. That's something you should look into. So really kind of what's my advice with all this? Because you have a lot of things flying around. You have a lot of people giving advice, and you have a lot of people telling you that the market is going down, and then some people are telling you that the market is going up. So what are you going to do if you're not Warren Buffett and you don't have $200 billion sitting on the sidelines, and everyone is telling you that things are going to go higher, some people are telling you things are going to go lower, that the market's going to crash? What are you actually going to do? Well, one of the things that you can do is you can diversify your portfolio. You can have a little bit of stocks, a little bit of bonds, a little bit in cash, because cash is a good asset to have. If you're dabbling in real estate, then you should do that. But here's kind of what I recommend fully. The best cash producing asset is your time. Most people don't have passive income, and most people don't have the amount of wealth that you really need to have for passive income to make a dent. So for example, if you've got $5 million and you put that in a 5% money market account, you're generating $250,000 a year. That's if you have 5 million. So you have to have already gotten that 5 million to have that passive income. It's the same with real estate. You need the money to have the real estate. And the people that say, look, you can start out with nothing. Yeah, you can build it with nothing. But when you're really starting to generate passive income where you can actually enjoy your life and not hoping that something doesn't fail, that takes time. That requires really a couple $1 million in assets that have been paid off or are close to being paid off or have low enough interest rates to cash flow. So the reality is that the most important thing that you have that you can trade is your time. And as a lawyer, I do that, and if you're a garbage man, you do that. It doesn't matter what you are. You're most of the time you're trading your time for some kind of money, and that is the ability to get money quickly, and then you deploy that money little by little in things that you understand, in things that you've researched, using, if you need, professionals to help you, and that is really how you build true wealth. The way you build true wealth is not winning the lottery, is not trying to get these passive income schemes, but really trading your time for money and slowly building up your wealth in order to eliminate that kind of time equals money equation. That's really my advice. After all that, that's really what I have to tell you. That's the long story short. Keep working, keep pushing, make money, use that money to buy assets, and you should be fine, regardless of what the stock market does, regardless if there's a run on the bank, which I don't think there's going to be a run on the bank. But whatever you do, if you have that game plan, you'll be fine. Let me know what you think. Do you have a game plan? Do you think there's going to be a run on the bank? Like, comment, subscribe. I want to hear from you. Talk to you later.